Mr. Jaffe, Dr. Jaffe, in your testimony, you talked about the period between 1950 and 1990 when homeownership rose to 64%. What was the percentage during that time frame of GSE involvement in the housing market?
Well, the GSE growth was steady over that period. If you started in 1950, it was minimal. It was maybe 1 or 2 or 5% of the mortgage market. Even by 1980, it was only maybe 10% of the market. So I would describe the period from 1950 to 1990 to be a U.S. mortgage market that was dominated by private market bank participants.
Okay, so by 1990, it was what, roughly? Was it
all in, maybe 35%?
35% by then? And we had a 64% homeowner number, is that right?
Exactly right.
And now today we have 90% GSE guarantee according to your testimony, written testimony.
Yes.
On page 3, I guess it is. And we have 65% homeownership, is that correct?
That's correct.
So basically we've almost tripled the amount of GSE involvement and basically no change in the amount of homeownership. Is that basically correct?
That's correct.
Okay. Mr. Pollack, you made a minute ago the comment with regards to 80-20 with regards to the ideal mix. Can you go back and explain just a little bit why you think that's a good number and why it would be not 50-50 or something like that?
If we think about how we used to think about the mortgage market, it was 15 or 20%, what we called government loans, which is FHA, VA. And I think realistically, politically, while the FHA has plenty of problems and lots of bad credit on its books, it will be reformed but not taken away. What is not government, in my view, should be private. That's how I get to 80-20. Mm-hmm. So it's 20% formally government, on budget, appropriated, 80% private, and 0% GSEs, Congressman.
Part of the discussion earlier was with regards to the 30-year fixed loan. And, you know, as a former banker, you know, I've made a lot of loans to individuals on homes before. And when you sit there and you look at their budgets and you look at the house they're trying to buy, and if it's something they can afford to have a proper down payment, and you look at how they want to stretch it out to 30 years versus 20 years, if they just make an extra $50 or $100 or $150 a month, they can go from 30 down to 20 and save literally thousands and thousands of dollars. And I don't think we're doing them a favor by stretching it out to 30 years. I think we're doing an injustice by putting them in a 30-year loan. And Mr. Pollack, you made a comment a minute ago how this can be a detriment. I would like for you to expound on that just a little bit if you wouldn't mind.
I am also a former banker, Chairman, and I fully agree with your point.
You're recovering from that, are you?
I remember talking long ago to a guy who ran an old mutual. He still called it Building and Loan in downstate Illinois, and his loan was maximum 15 years. And if you didn't like the payments, you bought a less expensive house, because he said, look at the difference in the equity buildup between a 15-year and 30-year loan, and it's really quite remarkable. So there is a strong argument that the shorter loans, because of the much faster equity build for the borrower, can be more advantageous.
This is one of the ways that individuals save, is it not, to get equity in their homes as they make payments in it? That's one of the best ways that an individual can save. It's also, I mean, as we go through this process, we found that 7 years is the average length of a loan, and why do we need a 30-year mortgage whenever it endangers them sometimes whenever the markets fluctuate? So I'll stop right there.